Chapter 9, Introduction to Managerial Accounting course. We'll be seeing today how we're going to prepare budget. Budgeting is what we have to do today. Budgeting is part of the very first of the four management's activity that every manager has to perform when they're doing their duties. The first one was planning. In the planning stage of the work of every management, we define the goals, we define the objectives, we exploring different opportunities or different alternatives, which are going to bring us to our objective or our goal. And then we're preparing plan in form of budget. And later on, we can use that plan that we're going to prepare today in form of the budget for control purposes to see where we are compared to where we're supposed to be. Are we falling behind or are we going ahead? So the budget, what is budget? Obviously, budget will be quantitative plan for how we're going to acquire or from where we're going to get and how we're going to use resources, which are financial and any other, over the specified future time period. This is very powerful definition in terms of you to realize that in order we to use something, first we have to have it. And if we don't have it, we have to get it from somewhere. So the budget will be the plan, quantitative plan in terms of numbers. We're going to see numbers, which is going to tell you how you're going to get and for what you're going to use resources. One of those resources is financial resources in form of cash, obviously. And any other resources, we're going to see that we're going to use any other resources as well, which will be the resources. It can be materials, it can be labor, it can be machinery, anything which is related to our business. Now, act after preparing the budget is called budgeting. And when we're using the budget to control the organization activity, that we'll know as a budgetary control. As I said, we have two main functions for the budget. One is to use it for planning, and the second one is to use it for control. Planning will be on the planning stage, as you remember, from the very, very first chapter, involves developing objectives, defining the goals, preparing various budgets or various. Now, when we know that the budget is quantitative plan for what we acquire and how we're going to use it. Every time when somebody says budget, picture yourself quantitative plan of how we're going to get and how we're going to use resources. So we're going to prepare various of those plans to achieve each of our objectives. One objective can be, how can I go to Douglas College? My goal is right now, let's pretend in the morning, I'm sitting in the bed. Now I have to somehow magically move and transport myself or move myself to Douglas College. And then we're going to prepare quantitative plan. If you live at home at this time, then you're going to have to go get the car or get the public transit. That public transit is going to take you that much time. When you go to that station, you have to get out of that station. Then you have to walk that many hours or that many minutes, and then you're going to achieve your goal or to be on the lecture in Douglas College. That's one plan. The other plan can be, okay, after the Douglas College, I want to go back home and be able to cook myself some dinner. Then we're going to prepare different plan quantitative plan, which is going to involve materials and financial. Financial, non-financial. Financial will be the money, and non-financial will be the materials that we have to purchase from the store in order to make our wish come true or to have a meal at home when we finish our lecture. That's basically developing objectives, preparing various budget to achieve different objectives. Second one is the control. Control, which involves the steps that every management have to take to ensure that objectives or the goals that we set on the planning stage are actually achieved. Because again, it doesn't make sense or it doesn't matter how good you are on the planning stage if you don't achieving or not attaining the objective that you already set up on the planning stage. And that's the problem for most of the companies. We're going to see in the advanced managerial accounting, if you see me there, we're going to see the problem with the company is not that they don't have a plan. The problem is that they don't follow their plan or their execution of their plan is not in place. And that's how we're going to see, that's where we're going to see from the control stage on the management activities or management functions that we have to do in our management job. Once we apply the control, we're going to see are we actually achieving the objectives and how far or how close we are to our goal. What are the advantages when we have a budget? Well, one of the advantages is that the budget helps you to define what you actually want and what's your objectives. In fact, the budget helps you to achieve the goals and objectives. But if you want to think about the goals, then through the budget, you can define and make it specific what you actually want. What's your actual goal? You can use it in the personal level, or you can use it in the company, most likely in the company, because in the personal level, nobody wants to do all those activities, especially for free. So, but when you're in the company, yes, you can. When you become a manager of the company, then you can start defining what's the goal and what's the objectives, what we want to achieve in this company. Then once we have the goal and objectives, then we can communicate the plan, how we're going to achieve these goals and objectives in form of the quantitative plan that we already prepared for how we're going to get the resources and how we're going to use the resources to achieve the goal and objectives. Then we can start coordinating the activities. Which will be those activities? The activity that's going to help us to achieve the goal and objectives. Then we're going to see how we're going to allocate the resources. It's going to help us to understand what kind of resources we want, how we're going to allocate the resources, what will be the measure that we're going to use to allocate different resources. Obviously, when we have a goal and objectives, since those are something in the future, the budget itself is going to help us to think about the future and make a plan about the future. What we're going to do today in order tomorrow this to happen. That's why the future is not some distant kind of abstract, if we can say that way. It's more like a future is defined of what you're doing today. If today you're doing the right things, then tomorrow you're going to be on the right path to achieve your goals. So the future to some extent starts from today. It's not from tomorrow. It's not from 1 week from now. Most of the people thinking, oh, I wish this to happen in my life. And they're sitting and doing nothing. Well, guess what? 5 years from now, you're going to be exactly on the same stage. And you're going to say, oh, nothing happened in my life. I still wishing the same day. Did you do anything? No. If sitting and waiting, that's not going to help you. You have to have a plan. You have to start working on the plan. The budget also is going to show you if there's any potential bottlenecks or some constraints which can prevent you to reach your goal faster, or can help you to reach your goal faster. That's how we create this responsibility accounting. In the responsibility accounting, the manager will be held responsible only and only for the items for which they have control, not for items which they don't have control. We cannot blame the manager that we don't have we didn't achieve the budget sales during the coronavirus. Why? Because all the facilities was closed for public. So there's nothing the manager can do. Now we have to choose the budget period. Now, it depends on the period. The budget is going to have different names. One of the name is the operating budget. Operating budget is anything related to operations of the company. As we already know from the accounting 1110 on the current assets and current liability, those are the current assets are the assets which can be converted into cash within the operating cycle of the company or 1 year, whichever is longer. And the liability is the obligation that has to be paid within 1 year or current operating cycle, whichever is longer. The company, for that reason, when we getting the once we working with that terminology, operating cycle or 12 months, operating budget will be the one who will cover 1 year, 12 months operating cycle of the company, whichever is longer. Now, the different type of operating budget. One of the operating budget is a rolling budget, which is continuous 12-month budget, which or can be per quarter. Obviously, if we don't have that big operation in hand, then we can extend it to the quarters. And when we're doing this rolling budget, every time when let's say we're doing 12 months budget, and when the first month expires, let's say we're doing the budget from January to December, when we're moving from January 1st to January 31st, when the January expires, and we're moving to February, now we're going to add the January at the end after December, and now we're going to have budget from February till January 31st. When we come to the end of the February, and on March 31st, February is going to drop from the budget, and we're going to add it at the end after January. Now we're going to have budget from March 1st till February 28th or 29th, depends on the year. And that's how we keep rolling, keep rolling, keep rolling. That's why it's called rolling budget. We can do the same thing with the quarters, obviously. Now, the question will be, what will be the budget which having the quantitative plan for what we're going to acquire, how we're going to use when it covers more than 1 year, 12 months of operating cycle, that will be capital budget. And as you probably, I don't know if you know from the finance, but everything which is longer than 1 year, then the time which have to consider the time value of the money. And in this course, we're not going to talk about capital budgets. We're going to stay only with the operating budgets. How are we going to prepare the budget? We have a different way to prepare the budget. First, the easiest way is the top manager is going to tell everybody what to do and how to do it and what they want. The other option is we to ask everybody from the bottom to the top and prepare the budget. That will be called participative budget. Why is participative? Because everybody on every stage of the company participating in the preparation of the budget. What's the advantages if we have to do that participative budget? Since we're asking every people from the company, every member of the team, to participate in the preparation of the budget, individuals of all levels of organization, they get involved and they're viewed as a valuable members of the organization. That boosts their confidence and boosts their motivation. Once we get everybody to participate in our budget preparation, our budget will be more accurate. Why? Because the people who actually work with the clients and producing the single items, those are the ones who actually have the more accurate information. More distant you are from the operation, the less accurate you are on what exactly is used in the operations. Obviously, again, we're gonna help with their motivation. Motivation is generally higher when the individual participate of the setting their own goals rather than goals just to be imposed by somebody else. You already know from your personal experience, it's a way easy you to set up the goals for yourself rather than somebody else to tell you what to do, how to do it. It's called micromanagement, but some people call it micromanagement. But sometimes you have to step up, and you're going to see in your personal life, in life in the managers in the company, that sometimes you have to cut the opportunities for the other people in order to you to company to achieve what they want to achieve. But keep in mind that if you let the other people to participate in the setting their goals, that creates motivation. The other thing that we are going to achieve besides the motivation is since the individual is going to set their own goals, later on they cannot come back and say, you know what, those numbers were not realistic. Why? Because they set up the goals for themselves. Yes, you give them the freedom, then they use that freedom to set up the goals, and after that they cannot come back and say, you know what, something went wrong, and this and this and this happened. That's why I couldn't achieve. Well, you're the one who set up the goal. Now you deal with the situation, and that's how we're eliminating any excuses from not achieving the goal. Participative budget sounds interesting. It sounds like something that we want to have in our organization, but we have to be aware because having that participating budget, there's opportunity for budgetary slack. Now, what is the budgetary slack? Budgetary slack generally some numbers which are set up by the people with only one set in their mind. How can easily achieve the target and perform better in order to reach my bonus? For example, imagine I'm a salesperson for the car dealership. I already know I'm not a new salesperson. I've been working this job for, let's say, 10 years. I perfectly know what's my capability, which are my clients, what kind of clients I'm dealing with, what's the product that I'm selling. I know how to sell the product. So I perfectly know that there are good years and there are bad years. And once I sense how the sales going, I can easily be able to tell that this is a good year, this will be a bad year. And I know that in the bad year, I can easily sell 80 cars in total for the entire year. And in a good year, I can go to 150 cars. So when my manager comes and asks me, how many cars you budget to sell next year, since I already can predict how the year is going to go, and I know that my bonus is related to the number of the cars that I'm selling over the budget, I can easily set goal or set a budget which can be easily attainable. I'll say, okay, I know it's a good year coming. people now moving, instead of spending money on the property, most likely they're going to move to less expensive items, which car is one of them. So I can easily predict that maybe I'm going to sell like a 150 cars. So when he asked me, what's the anticipated sales for the next year, I can easily say 100. And once I reach that 100 and exceed the 100, I'm going to go to the manager, say, you know what? You see, I'm selling more than what we budget. I need my bonus. The opposite side will be the uh, production manager, who is evaluated based on the cost saving. So he's the one who knows very well the production cycle. He can easily predict what will be the cost. So when we ask him how much will be the cost for the upcoming period, he can easily inflate that number now. Why? Because his bonus is based on the cost saving. So once he do that, when the costs actually become lesser, which he anticipated, when that happens, he's gonna come and gonna say, "You see, I achieve a cost saving. Give me my bonus." Now, you as a manager, you should know about those tricks. And once you sense something like this, you're gonna step up and you're gonna change the number of the budget. That brings us to the budget committee, which is budget committee is the people who are paid extra to have a new responsibility, which is a new responsibility. They're the one who's gonna review overall policy matters regarding to the budget. They're gonna go coordinate the preparation of the budget. They're gonna say which team when has to prepare the budget, which manager has to submit it, how to submit it. If there's some disputes related to the budget, with especially with the budgetary slug, they're the one who's going to step up and going to solve the problem, and they will be the one who's going to approve the final budget. Once the final budget is approved, we can start the period. Now, in order we to be successful in the whole process of developing and executing the budget, number three, there's three important factors that you have to keep in mind. Number one is top manager must be enthusiastic and committed to the budget process. Think about it. How many of you are actually working? Is there any of you who are actually working? Julia one, Florence another. I do, okay. Question. How do you see your managers as enthusiastic and committed people who generally creating environment of nice working environment which motivates you to work harder, or you see them as people who generally calm, and when you go there, you just staying and working. If something happen, but if nothing happen, that's even better because you're just gonna get paid. What kind of type of manager you have? One has motivated. How about the other people? All of you have motivated people? That's great. If you have that environment, and the manager is the one who motivates you, that's great. But imagine you work in the environment when the manager is just he's just working. He doesn't even have a passion to come to work and motivate the other people. How this going to motivate you? I'm saying this for only one reason, because you be the manager one day and you be the top management. So you have to know what kind of attitude you have to have in order to make the other people get involved in the whole process. If you are not enthusiastic and you're not committed and you're setting the goals and after that you're not following your goals, everything's going to go like that because everybody's going to follow you. Now, if you don't believe me, we can most likely all of you is going to experience it on the personal level. If you don't already have, but one day you're going to have kids, and one day you're going to realize that when you're looking at your kids, you're actually looking at a reflection of yourself. And without realizing it, depends if you're enthusiastic and motivated and committed, your kids will be exactly the same. If you're whatever, and just calm down and just that's exactly what your kid's gonna be. So what I want to emphasize is you study here to be the manager, so you should know those things. Not everything comes from the management, means from you. The other one is top manager must not use the budget to pressure the employee or to blame them when something goes wrong. Yes, we prepared this perfect plan, but sometimes works, sometimes doesn't. When it doesn't work, we're not pressuring the employees and we're not blaming them if something goes wrong. Maybe that's not their fault. Maybe something else happened. Maybe we didn't predict something, we missed something. And the third one is the highly achievable budget target I usually prefer when the manager is rewarded based on the meeting the budget targets. What that means is if you set up an unrealistic budget with a very high target, most likely that target is never going to be achieved. And the people is going to, instead of getting motivated, they're going to get frustrated. Simple example is imagine, I mean, I hope that not going to happen, but let's for a second imagine there is a person whose kid is solid C minus in the classroom. Is it realistic we to expect that kid to become A plus within one semester? If we get the kid and say, you know what, from now on, you're going to start working hard, you're going to start study, and next semester, I want to see A plus all across the border for all the subjects that you're taking. Is that realistic? Most likely not. Why? Because it's too high. What if the kid don't achieve it? Then instead of being motivated, it's going to be even less demotivated, less motivated and even demotivated to do anything. So when you set up the goal, say, okay, let's go next semester, move to from C minus, let's move to B or to C plus. And then let's achieve a little. Once we achieve C plus, let's go another one. Let's go another one. Let's go another one. And once the kids start seeing that I'm achieving the target now, then the motivation is going to start increasing. Same thing with the employees. If you set up too high standards and people cannot achieve those standards, they'll be demotivated. And you're creating the environment which is not productive environment. The other type of the budget is the zero budget. Zero budget is the budget that every year we start with zero and start building again. Managers with who have to prepare zero budget standards usually are not happy because they're saying it's too time consuming and require a lot of work. So for that reason, what we're going to do, we're going to rely on the budget from the previous year, or we're going to do the rolling budget, and we're just going to adjust to the current situation. Now let's start preparing the budget. The master budget is the one that we're going to do. The master budget, as we can see here, starts with the sales budget. Why the sales budget? Because we already said on the definition of the budget. The definition of the budget was a quantitative plan for how we're going to acquire and how we're going to use financial, not financial resources. So first, in order we to do anything, we have to have something. In order to have something in the business, you have to start selling. That's why we start preparing the selling budget first. Once we see for whom you're going to sell, how much we're going to sell, what will be the selling price, then we can start seeing what do we need to achieve the sales. And obviously this budget, as you can see, is for the production company, our manufacturing company, which making product. Then we have to see what will be the inventory that we're going to support our sales. Based on that, on the inventory that support our sales, we have to prepare the production budget, which production budget will be for the product. Now we have to set up the product cost, which product cost we already know, direct material, direct labor, manufacturing overhead. So we have to prepare budget for all those three costs, direct material, direct labor, manufacturing overhead. But then we don't have to forget that, okay, product cost is one side of the cost. There's a period cost as well. So we're going to get the period cost, which is selling administrative expenses. And once we have all the period cost and product cost as a total cost in the company, then we can prepare the cash budget, income statement, and the balance sheet. That will be the objective of today's class, and that will be objective for your group assignment. So let's start. Let's start preparing the budgets. First, we're going to start with the sales budget. Everything, trust me, start with sales. Once we have the resources, then we can find out how we can spend the resources. So let's go. This company has to prepare the budget for the quarter ending June 30th. One thing that we have to make it clear in the very beginning, since they're making the quarter for every quarter, we have to know how many quarters we have in the year. Since it's quarter means 4, that means 4 equal periods during the year. 1 we divide 12 divided by 4, that's 3 months. Every 3 months, that will be our quarter. First quarter runs from January 1st to March 31st. Second quarter is going to run from April 1st to June 30th. Then the third quarter is going to run to July 1st till September 30th, and then we have October 31st to December 31st. That's our 4 quarters. The other thing that I want to make it clear, how distant is one quarter to another quarter? How far is quarter 1 from quarter 2? Let's think about it. Quarter 1, the last day is March 31st, where specifically the end is 11:59. When the second quarter starts on April 1st, 000, midnight. So how distant is first quarter from the second quarter? Technically speaking, only 1 second. 1 second is the distance between first quarter and the second quarter. So what that means? That means simply that ending balance for the first quarter will be beginning balance of the second quarter. Why? Because pretty much nothing can happen in 1 second. So that's what I want you to understand. Beginning balance for the second quarter is equal to the ending balance from the first quarter, or ending balance on the second quarter will be the beginning balance in the third quarter. And keep going, keep going, keep going. Now let's see the budget sales. That's the projection. At this point, I'm going to move to the Excel spreadsheet, and we're going to start preparing the budgets. In the Excel spreadsheet, once I share the Excel spreadsheet, we're going to see the same information. This company And you already, I hope you already downloaded the Excel spreadsheet. With your Excel spreadsheet, it's gonna come with the numbers, so you don't have to do the calculation, but I'm gonna do it for you regardless. So we have the budget sales for the first month of the second quarter. Our sales are 20,000. For the second month is 50,000. For the third one is 30,000. Now I can get the total sales for the quarter. For the quarter, my total sales, I expect to sell 100,000 units. In July, sales at 25,000, and in August, sales at 15,000 projection. My projected sales price is $10 per unit. That means total sales for April projected will be $200,000. In May, 500,000. In June, $300,000. So my projection for the second quarter is my total sales to be $1 million. That's my total sales. Okay, great. And in July, if I can keep going with the July and August, that will be pretty much the same idea, like those months. And if I format this just to be consistent, that will be 10 here. And then I can get the formulas, how much will be my projected sales in July and in August. But since we're focusing only on the second quarter, we're going to stay with the numbers for the second quarter. For July and August, those numbers are not important for us. And that's how we prepare the sales budget. As you can see, there's nothing scary here. It's just two numbers. One is the number of the units selling. The other one is the sales price per unit. And we just calculating the number of the sales. Okay, we have our sales. We're supposed to sell 100,000 units, $10 selling price, going to generate $1 million sales. Now let's see, out of those sales, how much cash we're going to get. Now, this company, all sales are on account. What that means, people getting it and not buying. Not paying. They're buying but not paying. So when they're going to pay, 70% of the current month of the sales are collected in the month of sale. 25% will be collected next month. 5% never going to be collected. The other information that we need is on March 31st, accounts receivables balance was 30,000 units, $30,000, which will be collected in full in the first month of the second quarter. So once we have this information, we can easily start preparing our collection budget. So again, sales are on account. This company collects in pattern 70% of the sales on the month of sales, 25% of the sales on the following month of sales. So if I remove all this information, let me get rid of all this information and start again from scratch. So what I know, I for certainly know that in April, I'm going to collect my accounts receivables balance from March. So the first thing that I'm going to collect in April is $30,000. Great. Then what I have to see? I have to see how much are my total sales. And once I plug here my total sales, I can start with that number. This one giving me exactly the same problem yesterday. Now let's go here and move it right this. And then I'm going to get these numbers and I'm going to flip it, answer, number. So this is my projected sales. So what says is in April, I'm going to collect 70% of the sales of April. And the other 25% of April sales, I'm going to collect it in May. So let's start collection. In April, we're going to collect 70% of the total sales in April, which are $200,000. So in April, we're going to collect this 200,000 times 70%, that's $140,000. So in total, in April, we're going to collect 170,000. As you can see, my sales are 200,000, but I'm collecting only 170. The other 25% of the 200,000, I'm going to collect it in May. So out of the April sales, I'm collecting only $190,000. The 5%, which is $10,000, they're gone. I'm never going to collect those one. So in May, I'm going to collect the 25 from the sales in April, plus I'm going to collect the 70% of the sales of May. Times 70, that should be 350,000. So in total, I'm going to collect $400,000. So from the sales of 500, I'm going to collect only 400. What's happened with the other 25% of the May sales? Those going to be collected in June. That's 125 collected in June. Also in June, we're going to collect the 70% of the sales of June. I'll put the percentage here. And once we put those percentages, we're going to see how much we're going to collect in June. Now, as you can see, in April, we're collecting less than what we're selling. In May, we're collecting less than what we're selling. But in June, we're collecting more than what we're selling. So there's a justice in the world out there. And in July, what's going to happen is we're going to collect the remaining 25% of the June sales. Actually, not that one. That will be this number here. And we're going to collect those 75. So if we take a look close look, those 75%, $75,000, which are the 25% of the June sales, will be our accounts receivable at the end of the quarter. Now let's see what's happened, how much we collected during the quarter. Once we combine all those, it's going to give me $905,000. So from my $1 million sales, we're collecting only $905,000. 75 left for July, for the first month of the next quarter. So technically, we're going to collect $180,000. So from the $1 million sales here, if we combine all together, those one plus the 75, from the $1 million sales, we're going to collect only 950. 50,000 is going to be gone. Why? Because 50,000 and 5% of $1 million, which we never going to collect. And that's our sales budget. Now let's see the slides. Again, the slides going to start with the collecting the 30,000 from April, from March account outstanding, and then we're applying the 70% in the current month, sales of the current month collected in the month of sales, 25 in the next month. And keep going the same pattern. May, we're going to collect the 70% of the sales of May, plus the 25% of the sales in April. Next 25% of the sales of May, we're going to collect in June, plus in June, we're also going to collect the 70% of the sales in June. So the question here will be, what will be the total cash collection for the quarter? We already saw it, will be $905,000. And once we run the numbers, we're going to see that $905,000 is the cash that we collected in the second quarter. Great. We're done with the sales and collection budget. Now, we know how much we have to sell. What's the next thing? We have to produce those items. Because if we don't produce those items, there's nothing for us to sell. Make sense? So now we have to start producing. Okay. For the production, what do we need? We need more information. First, this company management wants the ending inventory to be equal to 20% of the following month budget sales. And on March 31st, 4,000 units were on hand. Let's think about something. Imagine we are running coffee shop. We're selling coffees. Only coffee, nothing else. We're not selling muffins. We're not selling cookies. We're not selling anything else. Only coffee. Today, because of the games that are going on the FIFA World Cup, we sold all our coffee. Is that good for the business? What do you think? Is it good for the business if we sell all our coffee today? Okay. Yes. Why is yes? More sales, more profit. Absolutely correct. So imagine what's going to happen tomorrow. The first people coming 6 o'clock and they ask us, can we buy a coffee? What are we going to tell them? Hmm? What are we going to tell them now? No, we cannot sell you coffee. Why not? Because yesterday we have amazing day in our sales. We sold all our coffee. But if you give me your address and you give me where you're gonna be, once 8 o'clock Costco open, I'm gonna run to Costco, I'm gonna buy coffee, and I'm gonna bring you coffee right there at your working place. If that happen, what's gonna happen with this client? Are we ever gonna see this client again? No, why not? Because maybe he's gonna think that, you know what, probably yesterday they had another good day of sales. So if I go, there might be not coffee. So better not go with these guys. Same thing, like imagine this. You're going to the Safe on Foods or Safeway in the morning, 6 o'clock, you're the first one, and there's nothing in the store. Absolutely nothing. Empty store. Why? Because yesterday they saw all the items that they have. Would you ever gonna go to that store again? No. Probably you already know. Do you have this experience? You're getting those promotion for the selling, and you like the item. You're going there in the store, and they don't have it, and then going to another Safeway, and they still don't have it. Is that good for the business now? Yes, they saw all the items. That's great, but they don't have ending inventory to start the next day. So for that reason, we don't want to be one of those stores or those example for business, which they selling everything. That's why we want to protect ourselves and to be able to start next month by having at least 20% of the following month budget sales. That's why we're having this safety of 20% of the following month budget sales units. Now let's start preparing our budget. Production budget. Production budget is the one of the trickiest one. Why? Because we have to incorporate the idea that we cannot run out of items. So let me delete this one and let's start preparing the production budget. I know on your Excel spreadsheet you already have it, but we're purposely going to delete it and we're going to start again. What's our starting point? Our starting point is the sales. Our sales is the starting point. And then what we're going to do then? Then we're going to do some tricks. Before we do that, let's remind ourselves something. Inventory account. What kind of account is that? That's a asset account with normal balance debit. So let's make this asset account, that's T form. And let's put some labels here. Debit, credit, beginning balance, ending balance. So we're chasing since we're in the production company, manufacturing company, that will be the finished goods. Is the one that we're chasing. Yes, it's still inventory. So we have this finished goods and our debit is debit, credit is credit. What's interesting with the debit and credit in this case? The interesting part is that we're going to have in this account beginning balance and we're going to have ending balance. Interesting with this type of accounts is that beginning balance plus the debit, it's going to be equal to credit plus ending balance. Feels like we're going to Metro Town, if you remember when we're doing cost of goods sold. That's how it feels. Now, in this finished goods, what we're going to change, the debit is not going to be debit. This part will not going to be debit. This will be our production. And this one will be our cost of goods sold, but that will be, let's say, our sales. Once we're selling the items, they become our sales. Let's move it here. So if I substitute debit as a production, we're going to have beginning balance plus production should be equal to sales plus ending balance. So how can I express my production? Well, it's very simple. My production should be equal to sales, item that I'm selling, plus desired ending balance minus beginning balance that I have at the period. Well, that's exactly what we have to do. But we're going to prepare it in the vertical order, not in the horizontal. So what we're going to start? We start with the budget sales. Then we're going to add the desired ending inventory, which was 20%. That's how much I want to have the desire. So if my sales in May are 50,000 units, I want to have as a beginning balance in May or ending balance of April, I need to have 20% of the sales in May, which is $10,000. So 10,000 units. So in total, I need 30,000. I already have from the month of March or from the first quarter, I already have beginning inventory of $4,000 units. So how much should be my production? My production should be simple. 30,000 minus the 4,000 that they have should be 26,000. Next month, May, starting with my sales. Then I'm going to add the desired ending inventory, which is 20% of the next month's sales, or 6,000. Then I'm going to see how much I need. I already know that I have 10,000, which left at the ending balance in April. So they're moving as a beginning balance of May. So my production in May should be 56 minus 10, or 46,000 units. In June, we're going to do the same. But now in June, we're going to need to have 20% of July sales as our ending inventory for June, which is 5,000. So in total, we need 35,000 units. But we already have 6. So our production should be simply 29,000. Let's calculate for July. In July, we need to have the sales for 25 plus ending balance of 20% of the next month's sales, which is August, 15,000. So we need to have 3,000. Why we're doing July, we're going to see later. And then we're going to deduct the ending balance that we have from June. That will be equal to this month. And our production for July should be 28 minus 5 or 23,000 units. If we achieve this production, only when we achieve this production, then we can guarantee those sales and having the ending balance to start the next month. Otherwise, we won't be able to start next month. So let's see for the quarter, because we're chasing the quarter. What's going to happen in the quarter calculation? First, our sales, we know the first quarter is $100,000, 100,000 units. Great. Now we need to find what is the desired ending inventory at the end of the quarter. Not at the end of April plus the end of May at the end of June, but only at the end of the quarter, which quarter ends on June 30th. So what's our inventory on June 30th? Obviously, that will be the ending inventory from June. Since the quarter end up on June 30th and month of June end of June 30th, the ending balance for June will be the ending balance for the quarter. Then we're going to calculate how much we need. And we need 105,000 units. But we already have in that quarter, we already have started the quarter with some units. What was the starting day of the quarter? Was April 1st, which is the first month of the quarter. How much was our beginning balance of the inventory that we have on the April 1st? Was the exactly the same that was on March 31st, or 4,000 units. Okay, so how much we need to produce for the second quarter? Our production need to be 101,000 units. Only and only when you produce 101,000 units, that's going to guarantee us that we're going to have enough for our sales of $100,000 for the quarter. Plus, we're going to have 5,000 units, which is going to help us to start the second quarter. Sorry, in this case, the third quarter. Now let's see this one on the slides. Again, starting with the sales. Then we're going to add the desired ending balance, which is going to help us to start on the next month without running out of inventory and end up with unhappy customers. When we apply the 20% of the next month's sales, 10,000, we're going to need 30,000. Minus what we already have on March 31st, our production is 26. Now the question is, what will be our production, the required production in May? For that, we can go back to our Excel spreadsheet and see what the number for May was. It's $46,000. So 46,000 units. I'm still going with these dollars. It's units. So the correct answer here will be 46,000. And once we run all the numbers, what we're going to see is in May, we're going to have 50 plus 20% of the 30,000, which is 6,000. 56 is the one that we need. But we already have 10, so we have to will produce only 46. In June, we're going to get July, 5,000. 20% of July sales are 5,000. In total, we need 35, but we already have 6. So we need to produce in June 29. Now for the quarter, again, we're doing the horizontal calculation for the sales, 5,000, 100,000. Then we're thinking, at the end of the quarter, what's our balance at the end of the quarter? When the end of the quarter comes, end of the quarter is June 30th. So what we have to see, how much was our ending balance on June 30th? 5,000, that's become the ending balance for the quarter. We're calculating how much we need. Then we're thinking, what's the beginning balance for the quarter? Which month is the beginning balance of the quarter? April. Which day is the beginning balance? April 1st. How much was the balance on April 1st? 4,000. So what that means, we need to produce 101,000 units to guarantee 100,000, so we can have 100,000 for sales, plus 5,000 to start next month. We're done with the production budget. Now we can start preparing budget for the production cost, which is direct material, direct labor, manufacturing, overhead. So for direct material, we need more information about how much material we're going to use, how much material we want to have at the end of each of the months, because again, we don't want to run out of materials. And the next thing is we can calculate how much will be the cost for that material and how we're going to pay for that cost and when we're going to pay for that cost. So let's start one after another. Let's go first with the Excel spreadsheet, back to Excel spreadsheet and see what we're going to achieve there. For direct material, I'm going to push a little bit down everything. And we're going to start one after another. Everything starts with the production budget. Once we have the production budget, then we can start building up for the next information. Next information is, since we have the units required for our production, which are right here. Now we can start working with the next numbers. Let me delete everything and start again. First thing first. I believe here we have August as well. Let me copy this August because now the August is going to be important for our calculation. Required unit production. No, we don't need August. We only need July. Okay. So let's go one after another. Again, same idea. What we have to do is we to keep in mind that now we're not working with the finished goods. We're working with the raw material or direct material. And the calculation for the direct material was same like the finished goods. What that means? That means simply that beginning balance plus the purchases now should be equal to material that we use plus the ending balance. I have the T account, so let's get our proper terminology here. On the raw material, when we know the raw material is the one that's from where we're getting the materials, we need to purchase them in order to use them. And that will be direct material used in our production. So for that reason, used in production. That's why we need the production number. So in our calculation here, we're still gonna have beginning balance plus purchases now. Should be equal to our production plus the ending balance. So what we try to find out, how much material to purchase. Now our purchase should be equal to production plus ending balance minus the beginning balance. That's exactly what we're going to do, but on the vertical order. So we have our production. We already calculated 26,000 we need to produce in April. What we need to find out, how much materials we need to produce those one, to produce our production. And we need 5 pounds. And 5 pounds, and 5 pounds, and 5 pounds, and 5 pounds. So the total material that we need is 26 times 5, 130 pounds. And then we need another 230 pounds and another 145,000 pounds. In total, we need 505,000 pounds. That's for the quarter. In July, we're going to see for July what's going on. So once we have that, that's the production that we need. This is the material that we need to satisfy our production. That's not going to be production, that's going to be material needs, raw material needs. So the other thing that we want is to have the 130 pounds of material plus 10% of the next month's production. And next production, we need to have only 10% of that, 23,000. So in total, we need 153. But we already have 13,000 pounds of materials, which is sitting from the previous quarter. So in total, we need to purchase 140,000 pounds of materials. Next month, we're going to need 230,000 pounds to produce 46,000 units. But we want to have also 10% of the next month production, which means 40,500 pounds. In total, we need 244,500 pounds. But we already have from the previous month, if you remember, at the end of April, we end up with 23, which is the beginning balance for the May inventory, 23. So we need to purchase only 221,500 pounds in May. In June, we need the July materials that we need for our production. And that's we need to have 10% of that as a buffer. So we're gonna have we're gonna need 156,500 pounds. But we already have from the previous month, end of May, we have 14,500. So in total, we need 140,000 pounds to purchase in June. Now let's go with the totals for the quarter. If you remember from the previous, from the production, that's exactly what we have to do again. Total needs for production, we're going to get it as a calculation on the horizontal. We need 505,000 pounds. Plus, we need to end up with some ending inventory, which ending inventory is going to be equal to the 10% of the first month of the following quarter, which is July, or we need, since this quarter finished on June 30th, we're going to check how much was our inventory on June 30th, and we're going to see our inventory was 11,500 on June 30th. Quarter magically finished exactly the same day, so those will be exactly the same. Then we're going to see how much pounds of material we need. We need 560,500 pounds. And then we're going to check how much we have at the beginning of the quarter. The first day of the quarter was April 1st. So for that reason, we're going to check how many pounds we had on April 1st. And we have 13,000. So the 13,000 pounds become the number from the beginning of the quarter. So for the second quarter, in total, we need to purchase 503,500 pounds. And when you calculate those numbers, it's going to give you exactly the same. Okay, I'm going to go one step further. Now, remember, we pay 40 cents per pound, which means that in total, we have to pay, once we apply those 40 cents to our pounds, we need to pay $56,000 in April, 88,600 in May, 56,800 in June. For that quarter, in total, we have to pay $201,400. Great. How are we going to pay this? One half of the purchase, we're going to pay it in the month of purchase, the other half the following month. In March 31st, accounts payable balance was $12,000, which we have to pay in April. So let's prepare this schedule, which will be similar to what we already did for the receivables, but this time we're going to pay it. So we're going to get our cost per pound and how much we have to pay. Let me copy those numbers. That's a number, paste it as a number. So I have the numbers. That's how much we have to pay. So let's start paying. The only thing that we have to remember is, first thing that we're going to pay in April is the outstanding balance for March, $12,000 gone. Then we're going to pay the 50% of April purchases. Then the other 50% of the April purchases, we're going to pay it in May. In May also, we're going to pay 50% of the May, and keep going, keep going. So those 50% of 56, we're going to pay it in April. The other 50%, we're going to pay it in May. In May, we're also going to pay 50% of the May's purchases. The other 50% of the May purchases, we're going to pay them in June. Not that way. The formula should be right here, should be equal to this number times 50%. Then in June, we're also going to pay the 50% of the June's purchases. Yes, that will be obvious in this number times 50%. And the other 50% of the June purchases, we're going to pay it in July. So that will be 50% here. We're going to pay it in July. So what that means to us, in July, since in July we have to pay 28,400, our outstanding balance for accounts payable on the end of the quarter, or the end of June, will be 28,400, which we have to pay in July, which presents 50% of the purchases in June. Now let's see what's happened with the quarter. Let's get those totals here. And those totals as well. And we're going to see how much cash we have to pay. And once I combine all those together, it's going to give me that I have to pay $185,000. So that will be our accounts payable that we have to pay for that will be the second quarter. So now let's go and see the slides if we're matching the slides. Again, let's go back to the materials. First, we're preparing the budget for the direct material. We start with the production. We're multiplying by the pounds per 1 unit, and we come up with the direct material that we need to make our production, required production of units. Then we start working with the percentages of the 10% of the required ending balance, which is 10% of the next month's material needed. The 13,000, it's coming from the beginning balance that we started the quarter or ending balance of May 31st. So don't be scared if the beginning balance for the quarter is not given. If the ending balance of the previous quarter is given, you should automatically know that the ending balance for the previous quarter is the beginning balance for the current quarter. And that's how we're moving to the next one. We're calculating all the numbers and how much material we should purchase in May. I believe was 221,500. And yes, that's my guess was right. So how are we going to get that number? 46,000 production times 5, 230. Then we need 10% of the June's required material, which is 14,500, which give us 244,500 required, minus the 23 that we have at the end of April, which is beginning of May, 221,500. And once we prepare the entire budget for direct material, the last thing that we have to do is to be careful with the quarter numbers. Again, the total production needs for the quarter can be simply the total production times the number of units, or calculation horizontal way for all the material that we need to make our production. Then ending balance for the quarter is the ending balance for the last month of the quarter, since the quarter ends on June 30th and month of June, end of June 30th, those matching perfect. And then the beginning balance of the quarter is the first day of the quarter, which is April 1st. On April 1st, our beginning inventory was 13. So that's the beginning balance for the quarter. And that's how we get those numbers. Next thing again will be the paying 40 cents per pound. And we're paying half of the month of purchase, next half of the other month. We'll run the calculation. First thing that we have to pay is the outstanding balance for March, 12,000 in April. And then we're following the 50-50 calculation until we go and get to the end. The total cash that we need for disbursements, I believe, was 185,000. And yes, it is that. Once we run the calculation, we come up with the total cash that we need for disbursements for the material, 185,000. That completes the budget for direct material. Up to this point was the difficult part. Now it's going downhill. Now we have to do the direct labor budget. The good thing with direct labor is we don't have beginning balance, we don't have ending balance. It's a labor. So the only thing that we need is a little bit more information. The information is for every product that we produce, we require 3 minutes or 0.05 hours. The company has a special policy, which is called no layoff policy. So basically, the employee are paid 40 hours per week, regardless if they work less than 40 hours. In exchange of that, if they work more than 40 hours, they're not going to be paid overtime. They're going to be paid regular time. So for the next 3 months, direct labor force will be paid minimum 1,500 hours. So if the total hours end up with below 1,500, we're going to still pay them 1,500. If they're more, we're going to pay them door to door with them. So what we have to do, start with the production. Let's go to our Excel and let's complete the Excel for the direct labor. We already have it, but I'm going to make it again so it can be more interesting. So in this case, I'm going to push it down everything like this. And this one I'm going to push down a little bit. Grab this one, make it bigger like this. And let's start with our preparation, our budget. Let me make some changes here. And let's go. We have our production, 26, 46, 29, 101. We know that cost is the hours that we need to produce one unit is 0.05. And once we plug that hours, we can easily calculate how many total hours we need. 26 times 0.05. I need 1,300 in April, 2,300 in May, and 1,450 in June. Remember, we minimum pay them 1,500. So if they work less than 1,500, we pay them 1,500. So in April, we're going to pay them minimum 1,500. And we pay them $10 per hour. In May, we exceed the minimum, so we pay them actual. And June, we are less than the minimum, so we pay them the minimum. So in total, we have to pay them $53,000. Now there's a question, follow-up question, which is about what will be the total cost? So what will be this cost here if companies still follow this layoff policy, but now instead of paying $10 for the hours over 1,500, they're paying for those hours overtime or additional $5. So what we have to do in this case, see on which month we actually exceed 1,500 hours, or the minimum that we're paying for $10. For the month that we're exceeding that, how much is the excess over the 1,500? And for those additional hours, we have to add $5 more. So the only month that we're exceeding the 1,500 is May. How much we're exceeding those? We're exceeding those with 800 hours. For those 800 hours, we have to pay $5 more, which will be $4,000 more. So let's see the logic here. The logic is total hours for April, 1,300. We minimum pay them 1,500, so we pay them 15,000. In May, for the first 1,500, we pay them $10, which is 15,000. And June, they work 1,450, but we minimum pay them 1,500, so that's another 15,000. So the $15,000 each month stays. What's different? The difference is on the excess of the hours for May and May only, which we have 800. For those additional 800, we have to pay 15. And once we do that, we end up paying them 47,000 or $4,000 more, which are equal to the 800 excess times the $5 additional that we paid. So the answer here will be 57. Now let's go to the slides and complete those slides. Again, starting with the production. Applying the hours and coming up with the total hours. Once we come up with the total hours, we're going to see which month we are below the minimum hours paid and with minimum going to apply it. For the month that we exceed the minimum, the actual hours going to be taken into consideration. We're going to apply the $10 and we're going to get the total cost, which is $53,000 for direct labor. Again, the question is, what if we keep the same policy, but now we're paying overtime for the excess hours? Well, in that case, the only month that we're exceeding is May, and we're exceeding with $800. For that $800, we have to pay 15 or $5 additional to the scenario that we have. So the total cost will be $57,000. That completes direct labor. Now the next thing is manufacturing overhead. Manufacturing overhead. We're going to split manufacturing overhead into two components. Now we're going to see how the costs behave there. And we're going to find out that the manufacturing overhead, we have a variable component and fixed component. Variable component is related to the direct labor hours. And we're charging $20 per direct labor hours. Fixed component is the fixed cost, $50,000 per month. Which out of those $50,000, 20,000 are non-cash items. And then we have to prepare the budget. Let's go and prepare that budget for the manufacturing overhead. So we're going to get the hours, the production that we need to produce. We're going to get the hours. Once we get the hours, we're going to use now not the hours that we paid our employees, but the hours that they actually work. And for the actual hours, we're going to apply $20 per hour. So my variable manufacturing overhead cost will be $110,000. Sorry, $101,000. Then they're going to have fixed manufacturing overhead, which is fixed every month, 150. So the total manufacturing overhead cost will be $251,000. If we have to get the cash, the actual cash that we pay, we have to eliminate the non-cash item, which is depreciation. And we're going to see that for the first quarter, for the second quarter here, we have to pay $191,000 cash for the manufacturing overhead. Now, once we have that information, what we can do is we can see that our total manufacturing overhead cost is $251,000. And what else we can see is that total usage of the allocation base, since we're allocating the manufacturing overhead based on hours, is 5,050 hours. So I have the total cost versus total usage. And since we are on the reality of budget, means we are on the estimation. And since we are on the estimation, we can easily estimate our predetermined manufacturing overhead rate for the quarter. So the predetermined manufacturing overhead rate is going to be equal to 251,000 divided by 5,050 or $49.70 per hour. And that's how we're going to get predetermined manufacturing overhead rate. Why do we need that predetermined manufacturing overhead rate? To calculate cost of goods sold. Let's go back to the slides and following the slides for the manufacturing overhead cost. Again, we're going to split it by two components. Variable, based on the actual labor hours, applying $20, 101,000, and fixed, which brings the total manufacturing overhead cost to 251,000. So again, since we have the total manufacturing overhead cost and the total allocation base, which is direct labor hours, we can come up with the predetermined manufacturing overhead rate per hour. And then we're going to deduct the depreciation as a non-cash item. And we're going to see how much cash we actually have to spend for the manufacturing overhead. Done with manufacturing overhead budget. Now we have to calculate the cost of goods sold and ending finished goods inventory budget. What do we know? We know that direct material is for one product, £5, 40 cents per pound, $2. Direct labor, 3 minutes or 0.05 hours, time $10 per hour, 50 cents. Manufacturing overhead is applied based on the direct labor hour, which is 3 minutes or 0.05 hours. And the total manufacturing overhead, we already saw it is 49.70. So that means we have to apply $2.49, which make our product cost $4.99. Now the question is, what's our ending finished goods inventory? Now, if we go back to our calculation sheet with the Excel spreadsheet, we have to go to the production. Once we go to the production, we're going to see what was our ending desired inventory. Was 20% of the following month sales, or 5,000 units. So once we have that 5,000 units number, what I'm going to do is going to apply it. And once I apply the manufacturing overhead rate, I can get the total cost for my product. Let's put it in different colors. And that's my total production cost will be that much, 499. My ending inventory is 5,000. So that means my total ending inventory is for 24,950, which was our objective to come up with the cost per unit, which will become later cost of goods sold, and the cost for the ending inventory, which we're going to use for the preparation of the balance sheet. Back to the slides. Once we figure out that we have 5,000 units, we can calculate the ending finished goods inventory, 24,950. Done with this. Now let's prepare the period budget for period cost, which is the sales and administrative expenses. For the sales and administrative expenses, we also is going to split it by two, variable component and fixed component. The variable component will be 50 cents per unit sold. That's how much we're going to pay our salespeople. And the fixed component is $70,000. Out of $70,000, $10,000 are depreciation, so non-cash item. Let's go to Excel spreadsheet and prepare that sales administrative expenses budget. I know it's already there for us, but let's go over quickly. So I'm going to push it down a little bit here. And I'm going to make this one. So what we need? Now we need sales. Why? Because we pay them 50 cents per unit sold. And once we paid our variable to our salespeople, our variable cost here will be $50,000 for the quarter. Fix is fixed. So the total expenses for us will be 260,000. Now we already know that 10,000 of those, or 30,000 for the quarter, are non-cash items. So the cash that we have to pay, spend for the sales administrative expenses will be $230,000. Let's move to the slides and see what's next for us. Next is to prepare this again, this budget. Now the question is, how much is my total cash for the sales administrative expenses? We already calculated, I believe was $230,000. And once we run the calculation, variable expenses are 15, fixed 210, total 260. 10,000 is non-cash item per month, 30,000 for the quarter, 230,000 is the total cash that we have to spend on sales administrative expenses. Once we know that, now we can prepare the cash budget. Cash budget, few things before we do the cash budget. First, we're going to split it on the 4 sections. First section will be cash received only from the normal operation of the company. We're going to exclude any borrowings. Second section, we're going to include only spendings or payments for the operating purposes. And we're going to exclude any financial for the principals or interest on the borrowing. Then we're going to do the calculation. We're going to see cash that we received minus cash that we paid for the disbursement. Do we have excess of cash or deficiency? And if we have deficiency, we're going to find a way to get what we need or borrow. Or if we have too much excess, then we can think of to invest somewhere. In order to prepare that budget, we need more information. And this company maintains 16% open line of credit. So anytime they can go on line of credit, but they have to pay 16% interest, annual interest. They have to maintain minimum cash balance of $30,000. Again, they don't want to run out of cash. For simplicity of the calculation, they're going to borrow always on the first day of the month, and they're going to pay back at the last day of the month. So they're always going to be 1 month interest, full month. So that's make it easy because 16 divided by 12 is going to give you the interest rate for 1 month. And depends on the money that they borrow, you can easily calculate the interest. They're going to pay dividends in April, $49,000. In May, they're going to purchase equipment for $143,700. And in June, they're going to purchase another equipment with $48,300, for which they're going to pay in cash. Their cash balance for April 1st, or start of the quarter, was $40,000. Now we know this information. Now what we have to do, we have to start preparing the cash budget. For me, personally, this is the most, how can I say, exciting part, because technically we're going to see, do we have successful business or unsuccessful business? And if we have unsuccessful business, how are we going to do and what we're going to do? I delete everything. I'm going to start from the beginning. Again, we have this information here. So let's start. Our starting point is the cash that we had at the beginning of April. And it says at the beginning of the April, we have $40,000. Not 40, 40,000. Okay, we have this $40,000. Then we're going to see how much we collect away from the cash budget. We're going to go to the cash budget here. Sorry, for the sales budget. For the sales budget, we're going to see, and remember we did the sales and then we did collection. And for our collection, we come up with those numbers. So all those numbers have to flow in our cash flow. So the month of April, we collect $170,000. So month of April, boom, $170,000. Done. Total cash that we have, 210. Next thing, let's see for what we're spending the cash. First one is cash for direct material. From the budget to direct material, we're going to go there, and we're going to see that in April, we spent $40,000 for direct material. Direct labor. Direct labor, we're going to go to the calculation of direct labor, and we're going to see that we spent for direct labor $15,000. Manufacturing overhead. Manufacturing overhead, we're going to go to the budget, and we're going to see after we deducting the depreciation, which is not cash item, we spent $56,000. Done. Sales administrative expenses. For the sales administrative expenses budget, we're going to see that our expenses are 80,000, but that including non-cash item. Once we deduct it, we're going to spend only $70,000 for sales administrative expenses. Also in April, we're paying $49,000 for the dividend. So our total spending for the month of April are 230. Great. Where we are, do we have excess or deficiency? The way I see it, we're $20,000 below. And remember, they have requirements that they need minimum cash balance at the end of the month, $30,000. Now we are 20,000 below. Obviously, we need to borrow. First, we need to borrow 20 to become zero, and then another 30 to maintain the minimum requirement cash. So in total, we have to borrow $50,000. Let's borrow those $50,000. So the total financing for us will be 50,000. And once we add the excess of cash plus the borrowing, we're going to see that we're maintaining $30,000, which is the requirement. Now, next month, what we're going to happen next month? Next month, we're going to start with the cash that we had at the end of April, which was 30,000. Then we're going to add the collection for May, which is $400,000. And then we're going to have $430,000 total cash collected. Direct material for the next month is 72,300. If we don't, just check yourself, 72,300. Direct labor, 23,000. Manufacturing overhead, 76,000. Sales administrative expenses, 85,000. Then we're going to have to purchase the first equipment, which is 143,700. And we're going to check how much in total we have spent in the month of May. We spent 400,000. Once we do the calculation, we're going to see that we exactly exceed the cash with $30,000, which is magically our exact minimum required cash. In that case, we don't need to borrow money. We don't have money to repay the loan that we take, the line of credit, $50,000, but at least we need to borrow. Don't need to borrow. And that's our May. Next thing, June. June, we're going to start with the ending balance in May. And then we're going to collect 335,000 from our sales, 335,000. As you can see, in total, we're collecting for the quarter 905,000. So that's going to give us cash of 365. Then we're going to start paying for direct material, for direct labor, for the manufacturing overhead, for the sales administrative expenses. Plus, we're going to purchase the second equipment, 48,300. And we're going to see how much disbursements we have. We have 270,000. So now we have extra cash of $95,000. In that case, in this case actually, do we have enough cash to pay our borrowing and still meet the requirement for the minimum 30,000? Seems like we do. So let's repay those 50,000. 50,000. Oh. Okay, but we don't forget we have to pay them interest as well. Now we have to pay interest for we borrow at the beginning of April, and since we pay in June, we pay at the end of June. So we have 3 full months, which give us 3 divided by 12 times 0.16% bracket time 50,000, the amount of the loan or the credit that we took. That's going to give us $2,000 interest, which is, we have to pay, so that will be negative here. So in total, we have to pay $52,000. And our cash, we end up with $43,000 cash. So now we have our cash budget for our quarter. One thing I want you to know, if you ever start your own business, don't ever think to start your own business if you don't have this calculation to see from where the money gonna come, how much you're gonna end up having, how much you have to spend, when you're gonna have deficiency, when you're gonna have excess, would you have enough cash? If you have to borrow, from where you're gonna borrow, if you have to pay the interest, how much interest you're gonna pay, when it's gonna become positive on cash, and when you're gonna start generating positive cash. Again, if you don't have this calculation and the calculation doesn't bring you to the positive numbers on the bottom, don't even think starting business. Because you're going to end up with all the businesses which starting every month shine for three weeks or 3 months, and after that disappear. And nobody knows where they are and what they're doing. Why? Because they have no idea what they're doing. They never did the planning. They haven't even made their own budget. So let's repeat this one through the slides. Again, we start taking the information from the budget that we already prepared. And we're going to get from the cash budget, we're going to see how much we're going to collect from the direct material, how much we have to pay, direct labor, how much we pay, manufacturer, how much we pay, sales administrative, how much we pay, the dividend we have to pay. Since we are below 20,000, we're going to borrow 50 to become positive 30, and May we start again. Now the question here will be, what will be the excess or deficiency cash available over the disbursement in June? We already calculated that was $95,000. And that's $95,000. We're going to pay the credit that we took for line of credit for 50,000, and we're going to pay the interest of 2,000. Outstanding line of credit times 60% down. Fraction for 3 months over for the 1 year. And we're done. Now the last few budgets will be the financial statements. One will be the income statement, and the other one will be the balance sheet. For the income statement is very, very, very straightforward. Why? Because we already have the information. We already know our sales. We already know that we're selling from the sales budget. We already know that we're selling 100,000 units for $10. So that gives us $1 million sales. We already know from the cost of goods sold that each unit cost us, we have a product cost of $4.99 based on direct material, direct labor, manufacturer overhead calculation. So that's going to help us to get the cost of goods sold. Our gross margin, as you can see, is $501. Then we have the operating expenses, which coming from sales administrative expenses, which is the 260. Now we're going to include the non-cash item because we're not preparing the cash flow statement, we're preparing the income statement. So the total income before the interest is 241. Then we're going to check in the cash how much interest we pay. We pay $2,000, like that, 2,000. And we're going to calculate our net income for the second quarter is $239,000. The last statement that we have to prepare is the balance sheet. Now, for the balance sheet, we need a little bit more information. I'm going to delete this one so you can see how exactly we're going to come up with those numbers. We need a little bit more information for the balance sheet. And what will be that? Land, and what's the value of the land? Equipment, starting point. Common shares, retained earnings. So let's start first with the land. Land is 50,000. Since we're not buying new land, we already know we need to purchase. That will be the only land we have. Equipment, we're going to have $175,000 for the equipment. I'm going to put it here because we still have to add the two new equipments that we purchase. Common shares are 200,000. Retained earnings, we have to work with the retained earnings. I'm going to leave it for now. Now let's start preparing the balance sheet. First one, cash. How much cash we have at the end of the quarter. We're going to go and check our cash flow statement, and we're going to see that we have $43,000 cash. Accounts receivables. If you remember from our sales and collection, we come up that our accounts receivables at the end of the June will be the 25% of the sales from June, or $75,000. Raw material inventory, we already calculated. Actually, we didn't. Raw material is going to be from direct material. We're going to check how much is our ending inventory. And we end up that our ending inventory will be 11,500 pounds. But those pounds comes with the cost of 40 cents per pound. So that's going to give us $4,600 raw material inventory. Finished goods is the one that we calculated because we know that from the production we have 5,000 units. And we know that the 5,000 units time cost per unit is going to give us 24,950. So our total assets, current assets, going to be $147,550. Equipment, we have at the beginning of the quarter 175. So that will be the first number. Plus, from the cash budget, we purchased 143,700 in May equipment and 48,300 in June equipment. So we have total 367. So 367 is our total equipment. I'm going to delete this one now. So our total assets is 564,550. Now let's see the liability. Accounts payable. From the direct material budget, we saw that we haven't paid yet the 50% of the June purchases of material. So that's our accounts payable at the end of the quarter. So 28,400 is the accounts payable. That gives us total liability of 28,400. We don't have loan because, as you remember, we paid the 50,000, so we are line of credit free. The next thing that we have is the common shares. And the last thing that left is the retained earnings. Now, retained earnings is the interesting account. What's interesting about that account? I'm going to grab this finished goods account. And because I need the T account only, and we're going to start working with the T account here. Let me paste it. So what we know about actually, I need this debit here. What do we know about retained earnings? We know that it's a equity account. Normal balance is credit. So the beginning balance will be on the credit side. Ending balance also is going to be on the credit side. What else? What that means? That means that beginning balance plus the credit should be equal to the debit plus the ending balance. What else we know? Every time when the corporation or company generate net income, that will increase the retained earnings. Every time when the company pay dividend, that will decrease retained earnings. Also, net loss also is going to decrease the retained earnings. So what we're going to have? We're going to have the beginning balance of the retained earnings. We're going to add net income. Then we're going to deduct less dividend. And we're going to end up with the ending balance for the retained earnings. And that's exactly what we're going to do. So the beginning balance, we have it. Beginning balance of 146, 150. Let's make it that number. Okay. Then we have to see how much is my net income. And we have to see how much is our dividend that we paid. The net income, if you remember, the net income was equal to 239,000. And the dividend that we paid from the cash flow was 49,000. And that's going to give us the ending balance of this one plus that one minus this one of 336,150. Or in other words, beginning balance 150. So 146,150 plus 239 income. That's going to give us available of 315. Then we're going to deduct the dividend, 49,000, and we're going to end up with a retained earning for 336,150. And that will be our number here. Once we get this number, we're going to calculate the total equity. And once we're in the numbers, we're going to end up with the total liability and equity be equal to the total assets. Magically, we get the matching numbers. So our job is done. Our master budget is prepared. Let's complete the last two parts on the slides. For the income statement again, we're going to get from the sales 1 million. Cost of goods sold. We already know that we're selling 100,000 units. Cost per unit is 499. That will be cost of goods sold. Gross margin. Selling administrative expenses from the selling administrative expenses budget. Interest expense from the cash budget, and we're going to get net income for the period. To prepare the balance sheet, we're getting the additional information about the land, equipment, common shares, retained earnings, and we start our calculation. Cash from the cash budget, accounts receivable from the sales budget, raw material from the direct material budget, finished goods inventory from the production budget times the cost per unit. Land is land. For the equipment, we're going to add the 2 additional equipments that we purchase, and we're going to add up the total assets. For the liability, we're going to get it from the direct material that we owe 50%. Common shares and common shares, the retained earnings, we're going to do the calculation beginning balance plus the net income minus the dividend, ending balance for the retained earnings, and we are done. This is another information for another company, example for the other budgets that you may see. Now the question is what we prepare. Obviously, we prepare the master budget. In other words, by definition, we prepare static budget. Why is called static budget? Because it's applicable only and only for the level of sales that we state in the very beginning. If the sales move with 1 unit up or down, this budget is not going to work. Then why do we need the static budget for? For planning purposes. But we cannot use it for control. Only for planning, yes, we can use it, but not for control. Based on the static budget, we cannot evaluate are we overspending or underspending, or are we achieving the sales are going up or going down. Only we can see if this happened, that's what's going to happen. If something else happened, then we have to adjust our budget. So that's why we're moving to the flexible budget. Flexible budget will be prepared for different level of activities. In other words, we can go with the best case scenario, worst case scenario, or different changes. If there's something happen, what's going to happen? What we can expect. If this happen, what we can expect. And try to be close to reality. So, in preparation of the static budget, we're following some logic. Means that fixed cost is always fixed cost within the relevant range. And variable cost is per unit is always the same. But variable cost in total is driven only by the level of activity. Now let's pretend for a second that we have this static budget here for the machine hours 10,000, and we compare it with the actual results, which machine work only 8,000 hours. Obviously, the cost and everything will be less. Why? Because we're not using the capacity of the machine that we projected. We're using the 2,000 hours less. And as we can see, all across the border, we are on the favorable variances. It looks like we're supposed to spend 40,000, but we're spending 34. We're supposed to spend 30,000, but we're spending 25,500. But the only thing that we can see is that we are different realities. Our budget is for 10,000 machine hours. Our actual results are 8,000. So if I'm comparing those numbers and come up with these variances, am I accurate? Is this actually tells me how much I'm overspending or underspending? That will be the question here. Since I have the variance on the machine hours used. So, shall we rely on this favorable variances or not? Is this actual variance? Is it actually favorable? So, in order to answer this question, we have to do something else. First, obviously, we cannot rely on those numbers. Why? Because we're comparing two different realities. In order to come up with the actual overspending or underspending, we have to adjust the static budget into the actual hours of usage. So what we're going to do, we're going to prepare the different flexible budget. How are we going to do this? Very simple. By knowing that, again, total variable cost is driven by the usage, not by the cost per unit. Total fixed cost is unchanged within the relevant range. So what we're going to do, we're going to take these numbers and we're going to see if my budget is prepared. So I expect 40,000 to be my cost for the indirect labor if I using the machine 10,000 hours. So how much is my indirect labor cost for 1 hour? And that will be very easy. That will be $4. Indirect material, $3 per hour. Power, 50 cents per hour. That's my variable cost. Fixed cost is fixed cost, doesn't change. So knowing that I can easily come up with the variable cost, pay attention for this because I'm going to give you this, I believe I'm giving you this question for the final exam. You to move from the static budget to the flexible budget into adjust to the level of activity, which is the actual activity. So once you come up with the cost per unit on the variable cost, I can easily prepare different budgets. And I can prepare budget for the 8,000 hours, for 10,000 hours, for 12,000 hours by knowing that the cost per unit is always indirect labor, $4, indirect material, $3, power, 50 cents. The usage, when I apply the usage, I'm going to get the cost. Fixed cost is fixed cost. They're never going to change. Once I prepare that, then I'm going to compare the actual results with my flexible budget. Now, on the actual results are 8,000. My flexible budget I also have for the 8,000 units. So when machine works 8,000 hours, my projected indirect labor cost is $32,000. Now I can make comparison with the actual results. So if my projection is 32 to spend $32,000 indirect labor, and in reality I'm spending 34,000, that means I'm overspending $2,000, which means unfavorable variance for me. If my expectations when I using the machine for 8,000 hours is to spend for the indirect material $24,000, and in reality I'm spending $25,500, that means I'm overspending $1,500, which is again unfavorable variance. On the power, I expect when I'm using the machine 8,000 hours to spend $4,000. In reality, I'm spending $200 less. That's a favorable variance. So again, on the indirect labor, 32,000 I'm expect to spend. In reality, I'm spending 34. That triggers $2,000 unfavorable variance. For the indirect material, I expect to spend 24. In reality, I'm spending 25,500. That triggers 1,500 unfavorable variance. And the only favorable variance I have is for the power. For the insurance went up with $50. That's unfavorable. So now I can compare the numbers because they're on the same reality. I adjust my static budget to the flexible budget, which is the same level of activity, but now for the flexible budget, I'm using the same assumptions that I use when I'm preparing the static budget. I just change the level of activity to adjust to the actual level of activity. So as you can remember, on the starting budget, we have the favorable variance. Looks like we underspending, but in reality, we are overspending $3,350. So since we cannot rely on the starting budget to compare with the actual, in the middle, we have to prepare the flexible budget, which is for the same level of activity, which is the actual result. Once we do that, we're going to use the starting budget for the planning purposes, but for the control and cost control, we're going to use the flexible budget adjusted to the actual activity, and we're going to start chasing the variances for the different costs. That's what we're going to do next time. Next time, we're going to start working on the variances, differences between the flexible budget and the actual results. Non-for-profit, what we're going to do with the non-for-profit? Same thing that we're doing for profit. Exactly the same uh, assumptions for preparation of the budget. You already know the provincial level, the federal level, all those levels preparing budget for every year. How are they going to gather the information? I mean, they can do participative budgets, but they doing different for different purposes, different budgets. For the education, one budget. For the what will be that? For medical expenses, different budget. The interesting thing for the budget is when you see what the people spending, when you look at the budget, you can predict what's going to happen. Now, think about it. If I'm Canada, let's say we are Canada, we are the Canada government. If we want to see educated people and increase the level of education in Canada in the next 15, 20 years, remember, whatever we're doing today is going to have effect later. If we want to increase the level of education in the next 15 to 20 years, where we have to spend money today, in which area of our life we have to spend money today, we can easily predict, correct? That should be on the education. If we put more money in the education system in Canada, after 15, 20 years, we're going to see the results. We're going to start working with the small kids, grade 1, 2. We're going to change the education system, and that's going to transfer to the elementary, then secondary, post-secondary, and we're going to see the effect in the university. And after 15, 20 years, we're going to increase the level of education of all the people in Canada. If you want to see healthy nation in the next 50 to 20 years, where do we have to spend money today? We want our people to have healthy life, to be on good health, and to have regular checkup and everything to be monitored. Obviously, we have to spend money on the health system, improve the hospitals, improve the medical care, improve the family doctors system, everything, specialists, adding more specialists. Now, the question is, where all the countries now, which is the part of the budget that all the countries increase right now? Which budgets they increasing? Can you help me with this? Oh, can you guys hear me? So think about it. Which part of the of the spending of the country, of the spending of the country, all the country right now increasing. And they have a minimum requirement to meet uh, some percentage here. Which one is that budget right now? Can you help me with this? Are you following the country spendings and all those requirements which are imposed by the European Union and NATO and all the things? All the country now increasing their military budget. So basically, my point is, if you increase the education budget, you're going to have educated nation. If you increase the health budget, you're going to have healthy people. That's easy to predict. Now, if you're increasing the military budget, what's going to happen? So that's how you can use, that's how you're going to use, you can use the budget. You can predict what's going to happen. I hope that never going to happen because probably you know I've been in military, not because I wanted to go to military, because I was mandatory on the age that I was at the place that I was living. It's not something that you play and bank on, but I hope that never going to happen. But again, teaching managerial accounting, predicting the future by seeing where the spending's going and how to project the spendings and how to predict the future. That will be the logical conclusion, unfortunately. So that will be the end of today. Now let's finish with something positive. What will be the positive? How about the games today? The positive is that you can predict what's going to happen tomorrow by seeing what you're doing today. That will be the positive. So if you want something positive to happen, please focus on what you're doing today. There is no future if you don't start planting the seed and taking care of the seed today. Nothing's going to happen. You can easily see, have you ever grown a plant out of nothing? I strongly recommend you sometimes go somewhere and chop a little leaf from the plant and then put it in the water. And once you put it in the water, eventually, if you chop it in the right place, but you have to know how to chop and what to chop, if you put it in the water, it's going to start growing roots. And once you plant it, you're literally going to see how out of nothing you can have a plant. And you can see how everything growing because you're putting effort and you're taking care of it and you water it and you nurture it and then become a beautiful flower. And the only thing is, don't remember, people only see the final result. They don't care how much effort take to get to that final result. But you as a manager, that's what your job is. You to take care of the small pieces and all elements of everything so you can get the fine job, which everybody gonna enjoy and everybody gonna congratulate you. But remember, nobody's gonna know how much actual effort you have to put on it. So work and everything will be fine. That concludes the lecture for today. And questions?